Yesterday, I had the opportunity to attend the 2026 Calgary Real Estate Board forecast for the real estate market right here in Calgary. And this was a fantastic event to attend with about 1,000 other realtors. They had so many insights. Doesn't matter whether you're an investor or you're in the rental market as a renter and looking to move into the Calgary real estate market at some point, or you're looking to upsize or downsize. There was so many different dynamic factors, and any one blanket sentiment to try and apply to the entire market would be completely wrong. Before we get started, hey guys, it's Iyer, your Calgary realtor. And for those of you who have been following this channel for a while, you know that I'm a very data-oriented realtor, and I absolutely love to dive into all the factors that affect the Calgary real estate market, not just short term, but mid and long term, and see where the market is headed, both if you're as an investor and trying to maximize your return on investment, or if you're just a home buyer but need a deep understanding of the different communities and where the new developments are coming in. That is what I love to get into, because it's very, very important to be not only happy today when you move into your house, but have a clear idea of where that community is headed in 3 to 5 years. And if that sounds like an experience you would like to have entering this market, then definitely reach out. My links are in the description, and I would love to have that call with you. Now, without further ado, let's get right into the presentation. And I will also be highlighting a lot of things that were mentioned during the conference that are not necessarily on these slides. Of course, these slides have a lot of data on them in terms of the amount of text and the detail it goes into. So feel free to pause at any point to actually read through the entire slide. I will be highlighting the key points, but the main point of this video specifically is to talk about what was spoken on that conference and what are the direct quotes from the economists when we attended the conference. And then at a later point, I'll be making 2 additional videos, one per economist. There were 2 economists that attended that event, and each of those videos will be a much longer version than this one, and that will go into not just the things that was spoken about during the conference, but also the overall sentiment and the actual specific data that is mentioned on every single slide. And of course, there were a lot of graphs that are not available essentially anywhere else that were shown during that conference. So I've gotten all of those. And if you're interested in something like that, then definitely stay tuned, and I'll be putting that video out soon. So the very first slide, we're going to get started by the summary by the Calgary Real Estate Board for the overall forecast for 2026. It's not going to have the very specific economy data and factors, which we will go into in the following slides, but it'll give you a good picture of overall what their sentiment was and what they expect to happen in 2026. So in 2025, housing market activity in Calgary transitioned from one that favored the seller to a more balanced condition, as improving supply in new homes, rental and resale markets occurred just as demand was returning to more typical levels, mostly due to slower migration levels. So this took much of the pressure off home prices, especially in the apartment and row segments, which reported the largest gains in supply compared to long-term trends. As we move into 2026, supply levels are expected to remain elevated for higher density homes. So that's the multifamily, as 2025's record high starts will continue to add supply to the rental and new home market as those units are completed. So the elevated inventory levels should cool off new homes starting this year, taking the pressure off supply growth by the end of 2026 and into 2027. Previous population gains and job growth are expected to keep sales in line with long-term trends. So we've had good economy data, and that's going to help sustain us. But no further uptick in demand is expected given the shift in migration and employment in the city. Now, the recent Memorandum of Understanding, the MOU that we had regarding the new pipeline development and shifts in regulatory policy signed by the provincial and federal government, provides significant upside for our city, and the province should have some progress from that. However, the economy benefits would not be expected to influence the housing market this year. Elevated supply across new, resale, and rental markets, combined with stable demand, is expected to prolong the time it takes to actually absorb the additional resale supply currently in the market. So overall, balanced to buyer market conditions are expected to persist in 2026, and it all depends on which property type you're going for. The additional supply in the apartment and row segments of the market are expected to weigh on resale prices in those segments. Meanwhile, annual prices should stabilize in the more balanced detached and semi-detached segments. Nonetheless, further annual price declines for apartment and row style homes will continue to weigh on total residential prices, which are expected to ease slightly over last year. As you can see in these two graphs right here, our sales, of course, has been coming down. Our year-over-year price growth has shifted slightly this year and is anticipated to go up a little bit. Getting more into that, you can see the 2026 forecast by property type. As you can see, the detached and duplex homes is actually anticipated to go up. Not a whole lot, but just a little bit compared to last year. Whereas other property types and total residential will go down as they are weighed down by the multifamily, which is essentially the apartments and townhomes. Townhomes less so, but more the apartments is what is expected to have more a down weight on the overall market sentiment. And something that the economists mentioned during the conference is Calgary is not following the national recovery headlines, for example. It's a little different because our market has already achieved extremely high amounts of sales, and we're just correcting down from there. So overall, the main takeaway is that 2026 is a normalized and digest year, and stable sales overall, but very different outcomes depending on which property type you're going to be looking at. Now taking a look at the forecast risks. So this will show what the upside and downside risks are. Overall, like I said, the economists had a more downside risk last year, but this year things are looking up, and she has a more positive outlook on where the economy is headed and the impacts that it's going to have on the Calgary market. So right here you can see it's shifting stance with the federal government regarding the regulatory barriers that impact the energy sector is the primary upside risk. The downside risk is that US tariffs and renegotiation of the CUSMA agreement will continue to create uncertainty as we head into this year. Hopefully that gets resolved with benefit to Alberta. Something else that is a factor in this economy is the builder behavior is also a risk variable for employment. And this is something that we will be watching very closely depending on where the housing starts head from this point on. Also, weaker commodity prices could also slow the transition and delay absorption of the inventory that we have if the commodity prices do not help the economy for Alberta. The overall takeaway from this segment in the conference was that the forecast shifts materially only if investment or jobs surprise to the upside, or if trade and commodity uncertainty actually deepens and delays the absorption. Now taking a look at the economic and also the rate context, why rates are not exactly going to be the savior of the day. So overall, rates are actually expected to be flat. The general expectation is that rates are going to be pretty flat going forward. As you can see here in Q2, Q3, Q4, you might have a rate cut, but it's not going to be anything significant, and it's going to have almost no impact when it comes to the impact on the market or reviving the housing market. We are at a point where a lot of other things have more weightage. The focus is that we want to keep an eye on the bond yields and see how those are going to drive the mortgage rates. But the perspective point being, high rates did not stop Calgary previously. So we had a high interest rate environment in 2022 and 23. So right now, it doesn't really matter in our market. There are a lot of other factors like affordability, jobs, employment, and what happens with commodity prices that is going to have a significantly higher impact compared to rates to drive the market. And the summary of demand drivers, all three of these things point to stability. So not a collapse of demand, but just stability. So what we are expecting going forward into 2026 is more of a balance to a buyer market condition, of course, depending on the property type. But what we want to do is achieve longer term trends, and just we're going to go sideways from there. We're not going to see any dramatic shifts on the up or downside, given that the agreements remain in place and what we expect in terms of all of those risks align with our expectations. If something happens completely different from that, then of course that's going to have an impact on the Alberta market. Therefore, the overall takeaway is that the market is primarily going to be driven by migration, jobs, and supply. Something we also want to keep an eye on is the oil price. So as of right now, it's 65. Generally, you do not want to hold levels below 60 for an extended period of time. That's when we start seeing some impact on the market in terms of jobs. But also, the oil companies now have come a long way in terms of optimizing their costs, and it's not what it used to be before. And that was the perspective of the other economists that came to this conference. So it is yet to be seen, and we will see what happens going forward. But we essentially want to hold good oil prices going forward. And Alberta's GDP did drop a little bit from last year, but it was surprisingly higher than what was actually expected. Now, getting into employment, which is one of the key drivers, and it's going to dramatically affect what's going to happen in the market. The key points from the conference that we had is that employment growth actually surprised on the upside this year when we were expecting the opposite. And employment is actually supposed to be pretty stable going forward this year. Now, the industry mix does matter, where jobs are gained and where jobs are lost. So healthcare, social systems was the number one growth driver right here. Finance, insurance, and real estate also are very, very strong. Professional, scientific, and technical were also surprisingly strong. The weak spots, however, are accommodation, food services, and those losses reflect cost of living pressure. So less as inflation comes up, people spend less, people go out less and don't do luxury items. So that was going to have an impact on those industries. Manufacturing was hit by tariff uncertainty. The one that is really concerning among all the losses here is the primary and utilities. That is a sector you do not necessarily want to see job losses happen. However, a lot of those are expected to recover this year, so that is something we do want to keep an eye on. And a key nuance being big difference when you have a high unemployment rate just because of pure job loss versus because so many new people enter your labor market, which is what happened over the last 3 years. Now, there's nothing there that tells that there's going to be a collapse. We're just adjusting to something that is a lot more normal after everyone that's come in and slowing down of the migration into the province. Now it's all about just finding those people jobs in the right sectors and expanding those industries and gaining new investments. So the main takeaway right now is that employment is a stability story, not a boom. So high unemployment is less concerning when it is labor force growth driven and not job loss driven. The next factor that we want to keep an eye on is the population growth. So the key points that were taken away from the conference in this point was that there is no question that these levels are, of course, coming down to where we were in the last 3 years. After record high levels in 2022 and 23 inflows, which was driven essentially by international migration. As you can see here, we had 107,000 from Q1, Q3 2024, versus now we are at just 19,000. So international migrants start in rental, and that's why that segment is dramatically affected by those migration numbers. Those international migrants always start in rental. Federal policy is reducing non-permanent residents, so these numbers are coming down and they're going to remain at these lower levels. The key guardrail versus what we had in 2015 to 2021 is still net positive interprovincial migration. So we would only worry if now that reverses to become net outflow. So right now we still have net inflow on both sides, even though they have dramatically corrected. But when we take a look at the longer term trends, we are pretty much just returning back to what's normal and should be a more sustainable rate of growth, both for the infrastructure and also the jobs available and a healthy economy overall, which is why we are not expecting an exploded demand in housing market. And that is just going to sustain the houses that we're now getting built, and we're going to expect more of a sideways movement. Talking about new homes, starts were actually supposed to decline last year, but they didn't. They instead hit new record highs with 20% increase in starts. So overall, as you can see here, we had 26,000 starts last year, but out of those 26,000, about 13 to 14,000, about 13,000 was actually apartment starts. So a lot of that is just purpose-built rentals. So there's a lot of rental units that's coming on the market, and that's the first part of the market that's actually going to face some impact from all these new housing starts. Since 2021, the market has actually shifted more towards rental construction, driven by all the incentives and programs, especially by CMHC. Now, if you compare that to 2016 to 2019, it was a more condo-based market than more rental-based, which now changes how for sale inventory starts looking. And it is important to stress the construction lags. So these are the things, once they start, take years to finish. So if we've had all these housing starts last year, you're going to see the impact going into 2026 and 2027. And as you can see, out of all those housing starts, only about 2,000 was duplex, which is all semi-detached, and that is a shrinking sector compared to everything else. It pales in comparison compared to the multifamily. And detached was about 6,000. That's a very small number compared to the amount of apartments that's going to be showing up on the market. The other interesting factor to look here is when you're looking at rental versus condo, you can see the amount of rentals that are being constructed in 2025 versus the amount of condos. So we are flipping the equation to the other side, and we're going to see a lot of rental units, and rents are expected to continue coming down. As far as the overall new home inventory, you can see going through multiple cycles over the past decade, the one that is the most volatile and has the up and down swings because it's the fastest in terms of adding a lot of supply to the market is, of course, the multifamily. So apartment construction is always the first one to surge dramatically, but the limitation on the amount of detached and duplex that you're able to bring on the market is heavily restricted and more or less consistent in terms of longer term trend. Something else about new homes, so there are almost 18,000 apartment units alone currently under construction. 63% of them are rentals, which keeps competing pressure on specific segments. That's why apartments, and very specifically apartments, is going to have a down year for sure. Now, bear in mind, it pales in comparison to what's happening in other provinces, but they've also had we've had significant gains in apartments for the last 3 years. So while we are having the downside, it does not yet negate all those profits and upside that we had for the last 3 years. It's just returning back to normals. As far as the overall geolocation goes, north and northwest is actually the biggest hotspot. So 5,000 apartment style units alone are actually happening right here in north. And southeast is also a major hotspot. Inner city nuance, so fewer starts, but about 65% are targeted to be rental. And a large share are concentrated on the Beltline. So a core warning though is this is not equal across all aspects of the city. Areas with the most construction are going to feel the most. So depending on where the more amount of construction happens, that's where you're going to experience essentially more impact on the, as far as the supply goes, and the impact on that particular segment, and also the rental amounts that you can get as an investor. The main takeaway, oversupply risk is not citywide, it is corridor and product specific, strongest where construction is clustered. Now zooming in a bit into the rental market, because that is the first domino that falls, and that's where we start seeing the effect carry on from the bottom of the market, so from apartments up from rows into duplex and detached. However, the impact is not the same, so it's not necessarily all of that what's being felt in the apartment market will carry on to detached. It's just apartment market is going to face the most amount depending on the amount of construction. So rental vacancies actually started rising in 2024 and continued with more softness expected. One main thing to keep in mind though when looking at rental vacancies by CMHC is that this vacancy only captures purpose-built rentals. It does not include people who are renting their homes or condos. So it gives you a picture of what's happening in the purpose-built rental sector. Ownership transitions slow. So when you have more rental supply, you don't necessarily need to leave that rental. And that shift to ownership might actually take significantly longer because people don't necessarily feel the pressure to needing to find their own home, and they can take time to browse the market, which is a healthy place to be in for first-time home buyers. Now, regional call-out, so northwest vacancy actually is around 6%, and that reflects the building pipeline that we have. Southeast vacancy, surprisingly, is low despite a lot of construction coming to southeast. And secondary supply can rise when condo owners cannot sell at target prices, so they often turn them into rental units. And the main takeaway is that rental softness reduces urgency to buy, which is a direct headwind for condos and entry-level ownership segment. So that was all the summary from the conference as far as looking specifically at the different market segments, all the factors that affect the real estate market directly, what happened in the past couple of years, how those things are changing, and what we expect going into 2026. Also identifying what the headwinds and tailwinds are, and identifying that there's a more upside potential than the downside risk. That being said, different market segments are going to behave very differently going into 2026. And so as far as the apartments and road style homes go, as you can see, there is more risk for downside as far as price correction returning back to longer term normals. However, you have to also take into account the double-digit gains that they saw over the last couple of years, and it still doesn't come close to taking away those gains. So a lot of those buyers are still sitting in a very good position, and depending on when you purchase, we can do a property evaluation for you to understand what your equity is right now, and depending on whether you're looking to downsize into a different property type or upsize, we can find out what your options are. And there's a lot of mortgage renewals that are also hitting this year, so that's why a lot of people are considering their options as far as changing their home and lifestyle, versus a lot of people felt stuck for the last couple of years because they didn't want to sell as far as the interest rates and just renewing at those numbers. But now, since the interest rates have come down, people have more options and choices in the market. From my perspective, directly boots on the ground, I'm already getting significantly more inquiries as far as buyers go right now in this market. There are a lot of people considering still to move to Alberta for the affordability, and I understand that the prices have gone up dramatically over the last couple of years, but it is still significantly affordable compared to other provinces. And so there are a lot of people still considering provincial migration, but also people within Calgary itself now considering additional options as far as upsizing and downsizing. So actually, since the last week of December after Christmas, that's when I saw an uptick in the number of buyers trying to reach out, ask questions, get property valuations, and try to understand their options for 2026. And if you feel you are one of those and you are in that position where you're not entirely sure and you're still trying to get a grip on where the market's headed, what is the right time, definitely reach out and we will set up a custom game plan for you, because there's different timing in the year for each person. Really, it comes down to what community you're moving into, what property type, and where those segments are expected to move, what future communities are expected to develop around you, what amenities are developing, and what your lifestyle is going to be going forward. We usually identify your needs for the next 3 to 5 years, depending on how old your kids are right now, what the school requirements will be in a couple of years, and design something, a plan around that, so that you're not just purely looking at homes, but you're looking at a future, and you'll understand and move in with confidence. And that is what my goal is, of course, as a realtor. So if that's you, definitely reach out. My links are in the description. Thanks again for staying again till the end of the video, and welcome to 2026. I am very optimistic for this year, and if you like this kind of information and you're looking forward to the longer form videos, which is going to be dramatically more data, stats, and go into each property segment, specifically look into what each property is doing, then definitely subscribe to the channel and hit that like button to show some support. And I'm also going to have another video which is going to look at the broader economy factors across Canada and what's going to happen on the geopolitical scale between Canada, US, and other countries, and how that is going to affect the local Calgary real estate market. So that was by the chief economist from ATB, and that was a different part of the conference that I am going to do all the notes and presentation for. And so if you're looking forward to that video, definitely stay tuned, and I'll see you guys in the next video. Till then, take care.